Get ready, because what I'm about to share is precisely why many people are totally misunderstanding the current market, and why that misunderstanding can be dangerous if you actually care about strategic positioning rather than just chasing headlines. Yesterday wasn't merely another interest rate cut, it was a clear signal. If you missed what the Federal Reserve subtly acknowledged, you're already behind the curve. Let me make this clear from the outset. The quarter-point rate cut itself was uneventful and entirely expected. Anyone acting surprised by a 25 basis point cut clearly hasn't been paying attention over the past year. That wasn't the real story. The real story is what came alongside it, a $40 billion liquidity injection when only half of that was needed for basic system maintenance. That's no coincidence. That's not a mistake. It's excess liquidity being funneled into the system while everyone pretends everything is business as usual. Call it what you want: balance sheet operations, technical adjustments, or maintenance funding. The label doesn't change the function. In practical terms, this marks the early phase of easing. Whether you call it stealth quantitative easing, slow QE, or drip feed QE, the effect is the same. Liquidity is turning back on. And here's where most people get it wrong. They expect instant fireworks. They hear quantitative easing and assume prices should skyrocket immediately. That's not how it works. Liquidity doesn't flood risk assets like crypto overnight. It trickles in gradually. It flows first through treasury markets, T-bills, repos, and credit channels. Only later does it spill over into assets that thrive on excess capital. Crypto lies at the far end of that spectrum. What's crucial right now is intent. The Fed is no longer aggressively fighting inflation at all costs. They are now managing stability. This is a monumental shift in policy regime. When central banks transition from restrictive to neutral, and then from neutral toward easing, risk assets stop being punished simply for existing. They no longer require perfect conditions. They just need time. Add another factor many people overlook: crypto has remained resilient despite restrictive monetary policy. ETFs have launched. Institutional flows have appeared. Regulatory stances have softened. Adoption has continued. XRP didn't wait for QE to exist. It stood firm while liquidity was tight. That matters because assets that survive in harsh conditions don't need much oxygen to move when the air comes back. But here's an uncomfortable truth many dislike hearing: this process won't be quick. Powell isn't flooring the accelerator. This isn't 2020 all over again. There's no emergency yet, and central banks always wait for something to break before acting aggressively. That's how they've always operated, conserving ammunition until absolutely necessary. This brings us to the real accelerant that no one can precisely predict: replacement risk at the Fed or systemic stress elsewhere. If leadership changes and a more aggressive easing approach takes over, everything accelerates. If unemployment spikes, credit markets wobble, or a major financial institution falters, easing shifts from gradual to urgent. That's when markets move violently. Until then, what we're in is positioning time, a dull phase where impatient investors get shaken out and disciplined capital quietly takes positions. This is the phase where narratives form long before prices confirm them, and it's precisely where XRP thrives, not on hype, but on infrastructure, liquidity rails, and regulatory relevance. Layer on what's happening outside monetary policy. Market structure legislation is crawling forward. Yes, welcome to politics. But the trajectory is clear. Pro-crypto regulators now occupy agencies that once blocked the industry entirely. Compared to previous administration hostility, current delays are mere noise, not threats. The key difference is intent. They're building frameworks, not weapons. Banks see this too. When Bank of America begins rolling out Bitcoin-backed products, it's not a trial run, it's a fear of irrelevance. Legacy finance doesn't move unless compelled, and it's moving now. This domino effect never stops at Bitcoin, it never has. Once access pipelines exist, they expand. XRP sits right at the convergence of payments, settlement, and tokenized value. So if you're wondering why price action is choppy despite strengthening fundamentals, that's your answer. Liquidity hasn't fully arrived yet, but it's turning. Markets move before headlines confirm, not after. That's the trap most retail investors fall into every cycle. Let's go one layer deeper, because many XRP holders completely misunderstand what institutional adoption actually looks like. They expect headlines screaming banks buy XRP, price explodes. That's not how this phase works. If you base your expectations on that, you'll get frustrated or exit early. Institutions don't buy like retail. They don't chase green candles, ape into spot markets, or announce intentions ahead of time. They build rails first, quietly and methodically. And that's exactly what's happening now. When Jamie Dimon openly states that blockchain stablecoins and smart contracts are real and will improve settlement and customer service, that's not bullish chatter, that's operational confirmation. JP Morgan already moves trillions daily using blockchain infrastructure. This isn't testing, it's production. Nobody experiments with $1 trillion casually. Once you grasp that, the entire market appears different. Here's a crucial point most miss. Banks don't care which token moons, they care about efficiency, compliance, interoperability, and control. They will build their own coins, ledgers, and permission systems, but that creates fragmentation. Bank of America won't settle on a JP Morgan coin. European banks won't accept a US-only system. Asia won't surrender monetary rails to one institution. You need a bridge, a neutral layer. That's where XRP fits, not as the system itself, but as the connective tissue between systems that distrust each other. That role won't show up overnight on price charts, but once embedded, it's incredibly hard to replace. This explains why XRP endures cycles while thousands of other tokens vanish. Add tokenization to the mix. Larry Fink calling tokenization the pre-boom internet phase isn't hype, it's a warning. Everything that can be digitized will be bonds, equities, treasuries, real estate, commodities. It's inevitable. It's efficiency math. Tokenized assets need settlement rails that are fast, cheap, liquid, and globally compatible. People say XRP won't be used for everything. That's correct. It doesn't need to be. Even a small percentage of global settlement volume passing through XRP dramatically alters the supply-demand equation. This isn't fantasy, it's scale. 10% of a massive system dwarfs most crypto markets. But stay grounded. None of this works without aligned liquidity conditions. Right now, liquidity is tight, rates remain high, and capital is cautious. That's why price hasn't yet reflected infrastructure progress. Here's where weak hands confuse delay with failure. Look ahead to 2026. Rates decline, QE returns in some form, risk appetite grows, and capital seeks yield and efficiency again. That's when the infrastructure already built starts pulling value through, not before. Markets don't reward preparation immediately, they reward readiness when conditions flip. Patience becomes an unfair advantage. Most want confirmation first, then position. By the time confirmation arrives, the asymmetry is gone. Institutions don't wait for clarity, they front-run it. Retail waits for price and pays for it. So if you're watching XRP today, wondering why it's inactive, you're asking the wrong question. The real question is whether you position before liquidity returns, or plan to react once everyone agrees the narrative is real. Now let's tie all this together with market structure and capital access, because this is where many XRP narratives crumble. People focus on price charts and timelines while ignoring the actual pipelines money flows through. Price is a result, structure comes first. For years, crypto operated in a regulatory gray zone that limited participation. Big money doesn't move without rules, not out of fear but accountability. Pension funds, asset managers, banks don't YOLO. They need compliance frameworks, custody clarity, reporting standards, legal protection. That's the real purpose of market structure legislation. What's different now, critically, is delay is no longer existential. A year ago, the question was whether the US would ever allow this. Today, the question is which version passes and how fast. That's a massive shift. Pro-crypto leadership now holds the SEC, OCC, and CFTC. ETFs are approved and accelerating. Banks openly offer crypto-linked products. That doesn't happen in hostile environments. Here's an uncomfortable truth. It doesn't matter if market structure legislation lands in 2 months or 8, direction is locked. Once institutions believe rules are inevitable, they start positioning early. That's why ETFs exploded even before full clarity. Capital waits for probability, not perfection. This is where XRP gets interesting again, not because of hype, but because of where it sits in the stack. XRP isn't trying to be a meme, culture coin, or governance experiment. It's centered on payments, settlement, liquidity, and interoperability. the boring stuff that moves money and makes it ETF, custody, and compliance friendly. When you see Bank of America launching Bitcoin-backed credit products, that's not isolated. It's a domino. Banks don't build one crypto product, they build frameworks. Once plumbing exists, adding XRP or Ethereum isn't revolutionary. Once retirement accounts, advisors, and wealth platforms gain access, you unlock a new class of demand. Consider this carefully. Retirement money doesn't chase pumps, it allocates slowly, steadily, and at scale. Even small allocation percentages matter when the base is in trillions. That's why conversations about 401ks, IRAs, and ETFs are far more important than daily price movements. Zoom out further. The old 4-year cycle narrative is breaking, not disappearing overnight but fracturing. In the past, everything moved together. Now capital differentiates. XRP, Bitcoin, and a handful of assets are treated fundamentally differently than speculative altcoins. That's why XRP can quietly outperform while most of the market moves sideways. This also means corrections don't automatically signal bear markets anymore. What we see looks less like boom bust and more like staged repricing, infrastructure builds, capital pauses, liquidity returns, price expands, rinse and repeat. That's how mature markets behave. Many retail investors get trapped here, expecting immediate fireworks after good news. When that doesn't happen, they assume the thesis is broken. Institutions expect delays. They plan around them. They accumulate during boredom, not excitement. So if you wait for XRP to prove itself before positioning, understand that proof arrives only after the market has repriced. By the time everyone agrees XRP is essential infrastructure, the asymmetric opportunity is gone. Now, let's zoom in on XRP itself, where most people either overhype or misunderstand it, sometimes both simultaneously. First, discard the notion that XRP needs retail hype to move. That's a relic from meme coins and early altcoin cycles. XRP doesn't live or die by sentiment. It moves when liquidity rotates. Full stop. The XRP ledger upgrades, AMM improvements, escrow fixes, version updates aren't flashy, they aren't meant to be. These changes are what institutions actually care about: predictable behavior, clean accounting, fewer edge case failures. No bank routes serious volume through infrastructure that's inconsistent under stress. These fixes are boring on purpose, and that's a good thing. Layer ETFs on top. ETFs aren't just tools to pump prices, they are distribution mechanisms. They enable exposure without custody headaches, wallet management, or regulatory friction. That alone massively expands the addressable market. Here's what many miss. ETFs don't need retail hype to grow. They grow through advisors, asset allocators, model portfolios, and retirement flows. If XRP ETFs continue growing at the current pace, this isn't speculative demand, it's structural demand. This demand doesn't panic sell on red days, it rebalances quarterly. Then there's liquidity. XRP has been criticized for price suppression, but the reality is nuanced. Much XRP liquidity is off exchange, handled through OTC desks, internal bank rails, and structured products. This means large volumes move without immediately impacting spot price. Retail sees little action while supply quietly absorbs elsewhere. This isn't manipulation, it's market structure. When that structure shifts and ETFs, custody platforms, and regulated on-ramps compete for the same available float, price discovery finally matters, not before. Now, the elephant in the room, cycles. XRP no longer trades like a purely crypto-native asset. It increasingly behaves as a hybrid financial instrument, part digital asset, part liquidity infrastructure. That's why comparing XRP to 2017 or even 2021 is lazy analysis. The players are different, incentives are different, time horizons are different. This also explains why obsession with the 4-year cycle is fading. Institutions don't care about narratives or Reddit sentiment, they care about regulatory windows, balance sheet efficiency, and settlement costs. If XRP saves money, reduces friction, and fits compliance frameworks, it will be used, regardless of where we are in a cycle. And here's blunt honesty. If your entire XRP strategy is waiting for the next big candle and then deciding, you're already late by definition. That's reactive, not strategic. The real opportunity is positioning ahead of consensus shifts, not after CNBC explains why XRP makes sense. That said, this doesn't mean blind conviction. XRP isn't guaranteed to dominate everything, nor does it need to. Even partial adoption across payments, tokenization, and settlement layers justifies materially higher valuations over time. Anyone pitching XRP as doing 100% of everything is selling fantasy, not analysis. The real asymmetric bet is this: XRP doesn't have to win it all, it just has to stay relevant at scale. So far it has. Now let's end with a critical point where most either gain an edge or sabotage themselves. Here's the uncomfortable truth: most XRP holders aren't underallocated, they're underprepared. They obsess over price targets but lack a framework for time, volatility, or execution. That's backwards. If you believe XRP is evolving into infrastructure, not a hype token, your expectations must shift. Infrastructure doesn't move linearly. It builds quietly, integrates slowly, then reprices violently when markets finally acknowledge it can't be ignored. That's why patience isn't a slogan here, it's a necessity. Let's talk about positioning, not predictions. The biggest retail mistake is tying conviction to dates: end of year, next cycle, 2026. Institutions think in windows, not deadlines. Regulatory clarity opens windows. ETFs open windows. Liquidity easing opens windows. You position before the window becomes obvious and manage risk while you wait. That means two hard truths many hate: XRP can stagnate longer than expected, and when it moves, it won't give you time to react. Both can be true simultaneously. This is why all-in or all-out thinking is dangerous. If your plan is to sell everything at $5 or $10, you're guessing, not investing. Markets punish certainty and reward adaptability. A smarter approach is layered: a core position you don't touch, a tactical position you trim into strength, and cash reserves so you never have to sell under pressure. That's how you stay solvent long enough to benefit when the thesis unfolds. Custody matters more than almost anything else. Every cycle proves this, yet people ignore it. Being early doesn't help if you don't control your assets. Exchanges fail, platforms freeze, rules change overnight. Self-custody isn't paranoia, it's basic operational hygiene. It needs institutions to continue what they're already doing: experimenting, integrating, and scaling quietly. Headlines come later, they always do. If you wait for universal agreement before feeling confident, you'll only buy consensus, and consensus is costly. So ask yourself the key question: if XRP never becomes a meme, never trends on TikTok, never gets fun, but does become useful, compliant, and embedded, are you positioned for that? If yes, price noise won't control you. If no, no prediction will save you. For clarity, none of this is financial advice. Do your own research. Manage your own risk. The market owes no one profits. Conviction without discipline is just another path to losing money. Stay rational, stay patient, and don't mistake noise for signal.